So PCG 2021-4 commences as of 1 July 2022. So the PCG actually names a few professions. And what I would suggest people do is, in terms of those professions, they are in the bucket. Just, no brainer. Clients that are in those professions should be on your contact list. So anyone in those industries should be contacted if you've got them on your list. However, if you think about the way that this is drafted, and effectively what this is knowledge workers that sell services that are largely intangible. You can think of, for example, quantity surveyors, IT consultants, anyone in dentistry. Those sort of sectors as well may very well fall into these rules. Where you are unsure of whether or not a business will fall into these rules or not, the ATO actually sets out 6 key criteria and asks practitioners to apply those to their client base to work out whether or not they would fall into this system. So the first of those key criteria is that the professional provides professional services to clients of the firm, or is actively involved in the management of the firm. And in either case, the professional and or associated entities have a legal or beneficial interest in the firm. So that's the first criteria. The second criteria is that the income of the firm is not subject to the PSI rules. If it's personal services income, it's dealt with those rulings rather than under this practical compliance guide. The third criteria is that the firm operates by way of a legally effective structure. For example, partnerships, trusts, companies, combinations of these, they would fall within these rules. The fourth key criteria is that a professional is an equity holder, either directly or through an associated entity like a practice trust, for example. The last 2 criteria are called gateways, and effectively they are the tests that we will apply under this particular ruling. Gateway is that the arrangement is commercially driven. These are things like asset protection. I would caution you that the practical compliance guide actually states, do not just generically refer to asset protection to pass this gateway. Actually drill down and work out why the arrangement in place would meet this criteria and document the purpose in question. What I'm suggesting is put in place some more basic advice as to the non-tax reasons why the structure exists and the way that it's set out, and document that on your end. So in terms of the accountant, look at the structure and go, all right, the shares, for example, let's say it's a company and the shares of the company are held in a discretionary trust. You may very well say, you know what, being an accountant is really risky. We get sued a lot in our personal names. That's why I want the shares in the practice held in a trust, because if I go bankrupt, this is just an example, there's a measure of protection because they're in trust. They're actually held not for my benefit only, but maybe the benefit of my whole family, for example. That might be a really key reason why you structured the way you structured. The more complex the arrangement, the more effort needs to be put in to documenting why it's complex. Because one of the things in that practical compliance guide is complexity. If they look at complexity and they go, why is this so complicated? They're going to just assume that it's to avoid tax. Now, in many cases, it's not. In many cases, there are very valid reasons why a commercial arrangement is the way it is. All I'm saying is, do yourself a favor, document that before the audit happens. The reason why is it also is stronger in terms of, evidence in the audit. Like if you're creating these documents as you're being audited, they're saying, is this guy for real? He's just covering up, or trying to paper over issues that exist in this file, rather than, hey, he's done the right thing. he's actually issued advice as and when this has happened, and it's a true reflection of what the arrangement is. So look, that's just a common sense advice. Build it at the start,
Mm.
always when this is happening. So look, we have the laundry list of behaviours that might trigger an audit just by virtue of what they are. There are four. The first is that there are financing arrangements relating to non-arm's length transactions within the group. So that will be a trigger point. The second is that there is exploitation of the difference between accounting standards and tax law. So where that's happening in amongst the group. And again, sometimes timing differences exist, but I would probably suggest that if those swings or differences are quite large, or if they're permanent differences, I'd be asking questions of the client, and I'd probably drill down, be a bit more focused, and pay a bit more attention to that arrangement. The third arrangement is arrangements where a partner assigns a portion of a partnership interest that is materially different to the principles that were established in both the Everett and Galland case. Don't, like, in my view, if you're assigning an interest, apart from obviously there being CGT exposed, just have a real think about whether or not, that's the smartest way to do things as well. It's just, it's a red light. The last factor that the ATO will look at under the second gateway, multiple classes of shares and units held by non-equity holders, such as salary partners. They view that as a risk in terms of being able to kind of siphon profits off. For example, let's say you've got a company that has shares that give you rights to discretionary income of individuals, but it's going to an associated entity of that individual. That's where it's going to be a trigger point. It's going to be, hang on a second, this guy's getting paid performance bonuses, but they're being paid those bonuses through equity instruments into their associated entities. I think, look, it's pretty no-nonsense stuff that you wouldn't do, or if your client does, you would talk to them about it very seriously. But, it's good to know that it's actually a listed factor to go, I need to talk to them if that happens.